All right, let's talk about hedge funds. You've heard the term, right? It probably conjures up these images of, I don't know, Wall Street titans, secret meetings, massive fortunes. But what are they really all about? Well, today, we're going to pull back that curtain and unpack this whole world. Let's dive in.
This quote just hits the nail on the head, doesn't it? Part elite investment club, part sophisticated financial laboratory. That really gets at the mystique. It's this mix of exclusivity and complexity that kind of makes them feel like this untouchable black box to the rest of us.
So, yeah, what are they really? That's the billion-dollar question, right? And that's exactly what we're going to figure out. We'll look at what they are, how they tick, and where they fit into the bigger financial picture today.
Okay, first up, let's get inside that so-called black box. We're going to crack it open and see what's actually going on under the hood.
All right, so here's the textbook definition, but let's break it down. A hedge fund is basically a big pool of money from different investors. A manager then takes that money and uses all sorts of, really advanced strategies. And the whole point is to chase what they call absolute returns. What's that mean? Well, it means trying to make money no matter what the market's doing, up, down, or sideways.
Now, a great way to understand this is to compare them to something we're all a bit more familiar with, mutual funds. Think of a mutual fund like a car that's built to drive on paved roads. It's safe, it's regulated, it pretty much just buys and holds stocks. A hedge fund? That's like an all-terrain vehicle. It has way fewer restrictions, it can go off-road, use leverage that's borrowed money, it can bet against stocks, and invest in pretty much anything. It's got a much, much bigger and more complex playbook.
And this is a huge deal, how these guys get paid. You'll hear about the classic 2 and 20 fee structure. So what is that? It means they take a 2% fee on all the money they manage every year, no matter what. And they take a 20% cut of the profits. The idea is to reward them for making money, right? But man, it also makes them way, way more expensive than your average fund.
All right, so with all that flexibility, what do they actually do? Let's take a look inside their strategic toolkit.
Okay, these are some of the heavy hitters. Long short is pretty cool. It's like playing both offense and defense. You buy stocks you think will go up, and you bet against stocks you think will go down. Global macro is about making these huge bets based on big-picture economic stuff, like interest rates or currency moves. Event-driven is all about capitalizing on specific company events, like a big merger or a bankruptcy. And arbitrage, that's about finding and exploiting tiny, fleeting price differences. Honestly, each one of these is its own universe.
Now, it's super important not to confuse hedge funds with another big name in alternatives, private equity. They're totally different beasts. A hedge fund is making these quick, tactical moves in the stock market. Private equity, on the other hand, they're buying entire companies, taking them private, and trying to improve them over like 7 to 10 years. So the big takeaway? Hedge fund investments are generally more liquid, meaning you can get your money out sooner. With private equity, your cash is locked up for a long time.
So, with all this complexity and risk, you can probably guess that not just anyone can invest. Let's talk about the price of admission.
Okay, the big question. What does it actually take to get into this club? The gatekeepers here are really the financial regulators, and they've set up some specific rules for a reason.
And you gotta understand, these restrictions aren't just to be exclusive. The whole idea is to protect people. Regulators basically want to make sure that if you're going to play in this high-stakes game, you have enough of a financial safety net and, enough know-how to actually understand the massive risks you're taking on.
So the first hurdle you've got to clear is this official designation called an accredited investor.
So what does that mean? Well, for an individual, you've got to have an annual income of more than $200,000 for the past couple of years.
Or you need a net worth of over $1 million. And get this, that's not counting the house you live in. So yeah, the bar is pretty high.
But wait, there's more. For the really exclusive funds, being an accredited investor isn't even enough. You have to level up to what's called a qualified purchaser.
And what's the bar for that? Generally, we're talking about having at least $5 million in investments. Hitting this level opens up a whole different tier of funds, ones that have even fewer rules to follow.
Okay, so let's say you meet the requirements. You can get in. The next question is, why? Why would you even want to? What job do these things do in a modern portfolio? So here's the sales pitch, basically. The big one is diversification, getting returns that don't just move up and down with the stock market. Another is downside protection. Some of these strategies are actually built to make money when markets are tanking. Then there's the hunt for alpha. That's just a fancy word for returns that beat the market, which is the holy grail for investors. And as we said, you can generally get your money out faster than with private equity.
And this visual really helps it click. For decades, a typical portfolio was just two things, stocks and bonds. But now, a lot of the big money pros think about a third bucket, the alternatives bucket. And that's where hedge funds live, right alongside things like private equity and real estate. The whole idea is to add another layer to your portfolio, something that behaves differently and hopefully adds a new source of growth.
But of course, it's not all upside. We have to talk about the risks. And then we'll take a quick peek at what the future might hold. All right, let's get real about the fine print. First off, those 2 and 20 fees can be a killer. They can take a massive bite out of your profits. Then there's transparency, or lack thereof. You often have no idea what the fund is actually invested in. You're also betting big on the manager. If they make a bad call, you lose. And finally, yeah, they're more liquid than private equity, but many have lockup periods. That means your money is stuck, and you can't touch it for a year or even longer.
So where is all this headed? Well, the industry is definitely evolving. We're seeing a massive surge in so-called quant funds that use AI and complex algorithms to trade. With all the chaos in the world, those big-picture macro strategies are getting really popular. And one more thing, investors are demanding more say, looking for customized funds that are tailored just for them.
And that really brings us to the big takeaway here. The old school playbook, 60% stocks, 40% bonds, a lot of people feel like it's just not cutting it anymore in today's wild markets. So the real question for the future is this: what role will these super sophisticated, super complex tools actually play in building the kinds of portfolios that can weather the storms ahead? Definitely something to think about. Thanks for joining me.